Most traders miss out on consistent profits because they overlook the three critical signals from the MACD indicator that should be analyzed before every trade you make. In this video, I will show you the exact MACD system I use to avoid false breakouts and capture front-side momentum. It also made me over $30,000 on a single trade last year. And oh yeah, this works whether you trade stocks, forex, crypto, futures, whatever. But first, you need to understand how moving averages work. Moving averages track the average price of an asset over a specific period, smoothing out short-term volatility to reveal the underlying trend. The key lies in their speed. Shorter-term averages react quickly to price changes, while longer-term ones lag but provide broader context. For example, the 9 EMA, exponential moving average, is highly responsive, clinging tightly to recent price action like a surfer riding a wave. The 20 EMA follows behind, acting as a middle ground. It filters out minor fluctuations but still reflects the near-term momentum. Finally, the 200 EMA crawls slowly, representing the big picture trend over months. When the market rallies, the faster 9 EMA surges upward first, followed by the 20 EMA, and eventually the lumbering 200 EMA. This creates what you call a bullish stack. All three averages aligned in ascending order: 9, then 20, then 200. A visual confirmation that buyers are in control across all time frames. This alignment doesn't only signal momentum, but consensus among traders, which makes it one of the most reliable indicators of a strong, sustainable uptrend. Now that you understand how moving averages work, let's break down the key components of the MACD. When you look at the MACD indicator, you'll see the MACD line. This is calculated by subtracting the 26-period EMA from the 12-period EMA. This is like your momentum speedometer. Then you would notice the signal line, a 9-period EMA of the MACD line. When MACD crosses above it, that's bullish, and if it's below, then that means it's bearish. Lastly, we have the histogram. These bars show the distance between the MACD and signal lines. Taller bars mean stronger momentum to either side. But the part where most traders go wrong is they mess up the settings of the MACD. This is a huge part of it because if you don't set this up correctly, then your signals will be way off and your technical analysis will be totally wrong. Think of it like reading a map with coordinates. If you create your own coordinate system, you'll end up in a different location than everyone else. In trading, that means buying when others are selling, which is a terrible mistake. So here are the MACD settings that I used: 12, 26, and 9. Feel free to pause and screenshot. These settings allow me to trade the front side of the move and avoid those pesky false breakouts. Let me walk you through how I applied the MACD in real time on this high-volume stock, which checked all my usual criteria for a morning trade.
Nice.
At the open, the signal line hovered above the MACD line. That is a bearish signal, as mentioned earlier. Even though I was eyeing a long position, this crossover warned me to hold off and wait for confirmation. Then came this halt. When trading resumed, the signal line remained above the MACD line, but the gap between them had gotten much smaller. This convergence signaled weakening downward momentum and hinted at a potential bullish reversal. That was my cue. I entered long right as the MACD line began its ascent above the signal line, marking the official bullish crossover. As you can see, a powerful breakout followed. The MACD line stayed firmly above the signal line throughout the surge, validating the uptrend. But here's where it gets critical. Midway through this push to the upside, the MACD line started curving toward the signal line. This divergence shows weakness. It should tell you that the momentum is fading and the trend is ready to reverse. I exited my position here, locking in gains just before the pullback. The MACD isn't just about entries, it's about timing exits with precision. Understanding convergence and divergence separates reactive traders from strategic ones. Here's a second example. You need to first make sure the stock you're trading meets the criteria before you even think about looking at the MACD. This one did. Just before the open, the MACD line was below the signal line. But then I noticed the volume increased as we got closer to the open, and the MACD line started getting really close to the signal line again. What does that mean? Exactly, it's a bullish signal. So I placed my order and the chart moved up really fast. But look at the MACD line. It basically spiked past the signal line. Sometimes it happens fast, so you have to move quickly. Then when the momentum was fading, the MACD line started getting closer to the signal line. Then came this massive dump. The MACD is really good at these signals. Those were two really good trades using the MACD. I want you to understand this. So here's a great explanation from one of the best traders out there.
Beginner traders who don't yet use the MACD are going to be more susceptible to falling into the traps of false breakouts. So this is, again, let's see, SGBX. This is a chart, 1 minute chart of a stock that I traded just yesterday. I actually made $5,000 on it. This was a pretty nice move. And it began right here at 9 a.m. with breaking news that came out. Okay, so we have breaking news that comes out top of the hour. And so initially, I see the stock on my scanners. I pull it up on the 1 minute chart. And of course, I pull up the level 2. Now, when I first take a trade on something like this, I'm not really looking at the MACD in those first few minutes, because the thing is, this is a stock that has been going basically sideways and then suddenly has news that comes out. So I know that the moving averages are going to be spiking up. That's what they're always going to look like when you have breaking news. So what's happening with these indicators? They are diverging, right? They're diverging. That's because the price is moving quickly. And so what's happening with the MACD? This blue line is moving way above the signal line. This is our signal line. And it'll continue to move up until the price begins to sort of stall out. So right here, the price started to stall out. The price rolled over a little bit. We came down to the support of the 9 moving average, but what began happening was our moving averages began to converge. They began to come back together. And that was especially noticeable right here when the price broke down. Because when the price broke down right there, that dragged the 9 moving average back down. That dragged the MACD back down. And right here, we have a MACD crossover. We have the cross where the fast line here, the actual moving average convergence divergence line, moves against the signal line coming back down. This for me is a critical indicator. When I see this crossover, I am no longer a buyer. As a beginner trader, you will find more accuracy if you're only trading when the MACD is open. So as a beginner, it's best to focus on setups that have the highest probability of success. So let's watch what happens right here. MACD is against the trade right here. So nothing in here, you should be trading. No trade, no trade, no trade. And then right here, we can get back in. This, as soon as I see this, and as soon as I see it curling here, I know what's happening. I know this is getting ready to cross over. Sometimes putting it right in front of you makes it hard to miss, right? If it's down here, sometimes you might just stop kind of looking at it. So I'll do this occasionally. And I really encourage this for beginner traders. Okay, so we're going sideways here. And then what happens as we come into the open? We get the crossover. Do you see this crossover right here? Boom, we cross over. So we cross back over and we cross over with strength. And look at this move that we end up getting. So we end up getting a squeeze on this all the way up here. And we stay open. The MACD stays open, it stays open, and we push higher and higher. So we come up all the way to this level up here, about 620. We start to pull back, and then here we go. That's another crossover. Imagine focusing on trading this only in this area here and only in this area here. How do you think you would have done? Probably pretty well. Trading it in this area here, it was sideways. This is not going to pay you. We don't make money buying at 5 and selling at 5, or buying at 380 and selling at 380. We want to buy at 4 and sell at $5, and we would love to do that inside of 5 minutes.
Check the link in the pinned comment for a 30-day free trial to TradingView, the absolute best charting platform in the game. But here are some things to keep in mind about the MACD indicator. If you decide to trade using the MACD, resist the urge to pair it with any other strategies. This could leave you more confused than ever and cause you to lose money. Use the MACD and pair it with a simple entry strategy. Now, this may sound counterintuitive, but don't rely only on the MACD. A lot of traders do this and it messes up their win rates. Heavy reliance on the MACD will actually end up hurting your profitability. So keep doing all your other due diligence, like making sure the stock or commodity you're trading has good volume, a good setup, and waiting till you have the right entries. Also, you need to remember when you add the MACD to your chart to use the right settings that I showed you earlier in the video. Professional traders aren't trying to double their account each month. They're building sustainable processes that work across different market conditions. But another problem most traders have is that they're scared to take trades and intimidated by the whole learning process. Watch this video next to help with that.